Imagine waking up one morning in 2026, checking your portfolio, and Bitcoin, once flirting with six figures, is staring back at you at $10,000. Sounds crazy? Bloomberg's Mike McGlone just called it the base case. Right now, as we sit in February 2026, Bitcoin's hovering around $68,000, $69,000 after a nasty dip from highs. Privacy coins are bleeding, and gold just smashed past $5,000 an ounce. Is this just another healthy correction, or are we watching the buy-the-dip era finally die? Today, I'm breaking down the story of Elias Thorne, a fictional analyst inspired by real signals who saw the cliff coming. Stick around, because the lessons here could save your portfolio or make you rethink everything. If you're tired of getting wrecked on every dip, hit that subscribe button and turn on notifications. Let's dive in before the next move happens. Look, the last 15+ years trained us like Pavlov's dogs. Red candle? Buy more. Buy the dip printed money through crashes, QE, COVID, everything. Post-2024 election Trump euphoria pushed BTC to insane highs, stocks to record market cap to GDP levels never seen before. But here's why it matters now. We're in February 2026, volatility is dead low, like a flat heart monitor before cardiac arrest. Privacy coins, Monero and Zcash, tanked hard first, classic risk-off signal. Gold and silver are ripping higher. This isn't random. It's the market screaming that cheap money is over and the system is reverting to the mean. If you've been stacking BTC thinking it's invincible digital gold, this video is your wake-up call. Mike McGlone uses what he calls a scaled map, Bitcoin multiplied by 10 to match S&P 500 behavior. Right now, both hover near dangerous levels. If S&P breaks support around 6,500, it's flirting close at 6,800, 6,900. Bitcoin's equivalent is 56,000, then lower. Why? BTC is beta on steroids. It amplifies stock moves violently. Example, in past crashes, Bitcoin didn't lead, it followed, twice as hard. When fear hits, privacy coins dump first. Monero and Zcash down 8 to 10% in a day? That's not noise, it's institutions de-risking. Liquidations pile up, forced selling creates no bottom holes. Real story? We've seen this before in 2018 and 2022. Early bleed signals the big purge. While BTC bleeds, gold surged past $5,000 per ounce, silver chasing $65 to $77. Why? Institutions flee to proven safe havens in liquidity crunches. Gold is 90+% above its 60-month MA, extreme, screaming economic stress. Mini story? In 2008 and 2020, gold held while risk assets cratered. History repeating? S&P divided by gold at levels matching 1929 peaks. Market cap to GDP at century highs. Low vol? It's complacency before the storm. When it snaps, everything correlated falls. Crypto hardest. Myth 1. The Fed'll just cut rates and save us. Reality. Cutting into a peak like 1929 or 2000 signals something's broken. Recession incoming, not rescue. Myth 2. Bitcoin is decoupled now. It's digital gold. Wrong. It's leveraged beta to tech and stocks. When risk-off hits, it gets hit harder. Myth 3, this is just a healthy correction. Buy the dip. The dip buying era ran on endless liquidity. That printer is out of ink. McGlone calls it the imploding bubble. Ignoring this is gambling, not investing. Tip 1, diversify beyond crypto. Add physical gold or miners. Why? In deflationary resets, hard assets win. Start small. Allocate 10 to 20% if you're heavy BTC. Imagine sleeping better when charts turn red. Tip 2, watch key levels religiously. BTC 64K support, S&P 5600. Break them, tighten stops or hedge. Curiosity, what if you're wrong and it bounces? Better safe than wrecked. Tip 3, reduce leverage. Spot if possible. Liquidations amplify crashes. Pro move? Set alerts for 10-year Treasury yield dropping below 3%. That's flight of safety panic. Tip 4. Build cash or treasuries. Elias's survivors? Bonds and gold. In a crunch, liquidity is king. Being right feels lonely until the bill comes due. Let's make it real. Mike McGlone's warnings aren't fiction. He's been screaming this on Bloomberg, X, interviews. In early 2026, as BTC dipped to mid-60K, he doubled down, 10K base case if equities peak. Privacy coins bled, gold spiked, exactly as scripted. Hypothetical Elias? He sat through the euphoria, positioned in gold and treasuries, watched colleagues average down into oblivion. Result? He preserved capital while the Moon Boys got purged. Lesson? Being early and contrarian pays when the crowd wakes up. Bonus insights? Copper, Dr. Copper, down 30%, global manufacturing stalling, recession precursor. Bonus 2, ETF flows. IBIT, massive volume on down days, equals institutions fleeing, not accumulating. Bonus 3, lop off a zero history. BTC done it before in big crashes. 100K to 10K? Mathematically possible in full reversion. Warning, don't panic sell everything. Position ahead. So, Elias Thorne shut down his screens, watching the great reversion complete. BTC at 10K isn't guaranteed, but the signals, McGlone's map, gold surge, vol compression, are screaming caution. The buy the dip religion? It had a good run. Now, protect what you have. If this hit home, smash that like button. It tells YouTube to show this to more people who need it. Drop in comments. Are you still buying dips or rotating to gold? What's your biggest takeaway? Subscribe for more no BS macro breakdowns. Next up, how to actually hedge in a deflationary winter. Turn on notifications so you don't miss it. Stay sharp out there. This market doesn't care about feelings. See you in the next one.